What does foreclosure mean in real estate? Hi, welcome back. Now, I'm Ted Thomas, and I've been involved in real estate since 1970. Now, in this episode, I'm going to cover what does foreclosure mean in real estate. Now, there's a lot of misconceptions about foreclosure, but by the end of this video, I'll have most of that straightened out. You'll understand it much better. So let me share the difference between a foreclosure in real estate, which is usually done by a bank, and a tax deed auction. Now, there's a major difference here, okay? Now, with a foreclosure, basically the bank is trying to recover their collateral. Now, this is really a low-profit business. I want you to be involved in tax deeds and tax liens, which are high-income business. So let's see if we can straighten out some of the differences for you. I'll do that in just a moment. And before I do that, I want you to stay tuned to the end of the video because I'm going to tell you about two big mistakes that you want to avoid. And I'll explain that they take place at the tax defaulted auction. And even the newcomers and the experienced people make these mistakes, and they cost a lot of money. So stay tuned. I'll come right back. It all starts out with a bank lending money. So let me give you some foundational material here so that you understand why foreclosures take place. Banks lend money on real estate properties. So the American dream is to own a property. And families want to own property, single people want to, everybody wants to own property so they can enjoy the appreciation and the tax deductions. Now, the banks lend money. Now, in many cases, the lending is so easy today that you can get a 97% loan on a property. That means you might only have to put up 3%. So the bank is really the one taking all the risk here. So the bank is concerned about their collateral. So they lend based on the value of the property and the value of the people. Now, the value of the people is, do they have jobs? So husband and wife working? Do they have enough income to pay it? Do they pay their taxes? Do they have good credit? All right, now what if the bank doesn't get paid? If the bank doesn't get paid, they're going to have to do something about recovering their loan. Now, the loan is attached to the property. Now, the property is their collateral. In other words, they probably wrote a mortgage on that property, and when they wrote a mortgage on the property, the people that live in the property are signing it. They promise to pay that mortgage. Now, the bank is not getting paid, so they want to recover that. So on the eastern side of the United States, they use a mortgage. This is a very cumbersome way to lend on real estate. It's a very cumbersome way to recover their collateral because they'll have to get an attorney, it'll have to go to a judge. This process can take a long time. A lot of people involved. Everything from the sheriff gets involved, the judge gets involved, the attorney gets involved. Many, many people are making money in this bad end of the market. All right, so that's not such a good thing. Now, on the west coast of the United States, the loan document there is called a deed of trust. It's just a loan again. However, if the bank wants to get their money back, they just issue a notice to the trustee, and so many days later, they'll have their collateral back. Why? Because it's just a matter of time, okay? Now, that time could be as short as 21 days in Texas, 60 days in Oregon, 115 days in California. You're getting the idea. They're going to get the collateral back quickly. All right, so the banks are lending big-time money, 97% on a property, all right? Now, if you want to be in the foreclosure business, then what you have to do is you have to go to foreclosure auctions, which took the bank many months to get to the auction. And when they finally get to the auction, the people haven't been paying. So if they owed 97%, now all of that might be up to 99% because you got all those back payments. Plus they haven't been paying the tax. Plus they haven't been paying the insurance. So if you're going to buy at a real estate foreclosure auction, you should expect to pay whatever is owed to the bank. So if the bank is owed 50% on that property, you're going to have to pay at least 50% to get it. If the bank is owed 75%, you're going to have to get involved and pay 75%. All right, so that doesn't look like a good deal to me. Where should you be? You should be in the tax defaulted business. And just like I changed 30 years ago, you're going to have to think about making the same change. Why? Because you're going to be able to buy properties for the back taxes. So tax defaulted auctions, the sheriff isn't involved. It just takes the treasurer. Now, the treasurer of every county is authorized to levy the taxes, they're authorized to collect the taxes, and they're authorized to confiscate the property for non-payment of taxes. All right, now taxes generally are 1 or 2% of the property value. That means a $100,000 house is probably got a tax of $2,000 or $2,500. Well, what if it was 2 years behind? It's only going to be $5,000 or $7,000 behind. All right, now that's where the auction is going to start, at the back taxes and maybe some penalties involved. All right, will the property actually sell for 5 or 10 cents on the dollar? No, it'll probably sell for more than that because other people have discovered this same thing. So you want to buy properties at 10, 20, 30 cents on the dollar. You don't want to pay 90 cents on the dollar. So you see there's quite a bit of difference. All right, now foreclosure's got a lot of people involved in it. Foreclosure is pertaining to mortgages on properties, okay? So the question I'm answering today is, what does a foreclosure mean in real estate? It usually means that a bank is foreclosing on a property and trying to recover their collateral. All right, the banks are trying to get their capital that they lent, they're trying to get it back so they can sell it. Well, if they lent 97% and no one's paid for a year, now they're in it over 100%. You're not going to make money paying over 100%. So the bank is either going to have to take a huge loss, but if you go to the auction and pay 90 cents on the dollar, well, you're going to have some losses because you're not going to sell a property, buy it for 90 cents on the dollar, fix it up, and sell it. It's not going to happen. Those properties end up going back to the bank. And all through 2008, through 2012, banks took back thousands of properties. Places like Phoenix, Arizona, thousands. Las Vegas, Nevada, probably hundreds of thousands in Las Vegas. All these properties went back. Let me give you an example. An example is a property that one of my clients just recently bought, and they bought a property at a tax defaulted auction. They paid $8,000 for a 4-bedroom, 1-bath property. $8,000 is what they paid. They spent a few dollars fixing it up, another $4,000. They were able to sell that property to a needy buyer on an installment sale. The installment sale is over 10 years. So over 10 years, they will get $52,000 in payments. On a $12,000 investment, their upside is $40,000. So you choose. Do you want to get properties for 10 and 20 cents on the dollar, or do you want to buy properties and invest 70, 80, 90 cents on the dollar? It's going to be up to you. Now, I'm going to button this up right now, but I'm going to answer a few questions before I go. The question is, should you sell or remodel your property? Well, right now we're in COVID-19 time, and everybody and their brother is at Home Depot. You can't get in the parking lot. So it seems to me a lot of people are fixing their property up because they're going to stay there. Whether you're going to sell or not is going to be up to you and your family. The question is the assessed value always less than the fair market? It depends upon how efficient the county is being run. It depends upon the county. If the county is very efficient, the tax assessor and the assessors are out there reassessing property, the market is either going up or the market is either going down. You can take advantage of the change in the market, all right? When the market's going up, the local government's going to have trouble keeping up with it. So the market values are going to be higher than the assessed value. Now that's going to reverse when the markets come down, because the market's going to start coming down, but the assessed value still might be high. So the answer to the question is, you need to understand the market by checking the multiple listing, checking the local neighborhood, look at what Zillow is saying, looking at what the MLS is saying. You need to make an evaluation. Is that market, which way is it trending? You'll notice newspapers, you'll notice people online, they're always talking about what's trending. Well, trending in the economic market is something that you need to understand. Okay, so let's talk about those two big mistakes. Number one, people show up at the auction and they right away start bidding. They're really excited, so they want to get going. You don't want to bid at an auction if you haven't seen the property. Why? What if there was a hurricane? What if there was a big storm and there was a flood? What if there was a fire? Something might have happened to that property since you last looked at it. So if you've not looked at it, don't bid at all. If you have looked at it, it has to be recent, very close to the auction time. So looking at a property, a lot of people don't do it, and then they get in big trouble and they lose a lot of money because the property isn't any good when they get there. So that's number one. Number two, you don't want to bid in an auction unless you have an exit strategy. So if you don't know what you're going to sell the property for, how can you plan on bidding? You could easily bid too high. So what you want to do is you want to plan your purchases. So you need to know exactly what the property is worth, what you can sell it for, and what you can sell it for quickly before you start bidding at auction. That's called an exit strategy. All right, folks, if you learned a lot in these lessons, we have a lot more for you, and all you have to do is join my community. Now, I have a gift for you if you do join the community, and all you have to do is go below me, but the gift is a quick start. Now, what does quick start mean? It's just a short course that's online that you can start right away learning about tax liens and deeds. The first part of the quick start is about tax lien certificate. The second part is all about tax deeds. You can learn both of those, and you can do that. Just go below me. It's a free course. It's my gift to you.